So the amount that we were taking over subject to was 65 cents on the dollar of today's market value. So there's all kinds of scenarios where there's tremendous value to be created. What is subject to? Subject to is a method where an investor takes over the existing mortgage payments of a homeowner without formally assuming the loan. Now, in your notes, guys, I want you to write this down, okay? Subject to is not a qualifying assumption, okay? We're simply taking over the payments. We're not alerting the bank. We're not asking for permission. We're not qualifying. Now, there is a qualifying assumable. You can assume an existing VA loan. So you want to go out and buy somebody that has a VA property, you can assume the VA loan at the then interest rate, assuming you are a veteran. If you're not a veteran, you can't do that, okay? So that's an option. We don't do any type of qualifying assumables. Everything we do is simply taking over the monthly payments of the property. In a subject to deal, the remaining balance of the mortgage, the portion of the loan that the seller still owes, is considered part of the buyer's purchase price. In other words, the seller's debt is counted against the agreed upon price, since the buyer will now be subject to the debt. Now, I'm going to give you guys some case studies here in just a moment, because as a company, we are doubling down on our subject to deals, because there's a lot of really great mortgage loans out there at 2.5% and 3% and 3.5%, and prices have gone up higher than they were in 2021 and 2022. So a lot of these homeowners have equity. We just closed one last week where the guy put $150,000 down when he bought it. And so the amount that we were taking over subject to was 65 cents on the dollar of today's market value. So there's all kinds of scenarios where there's tremendous value to be created.